On this episode of Industry Relations, Rob and I go beyond the headlines of recent earnings calls of Opendoor and Zillow. Let's go. This is Industry Relations, a podcast that's at the intersection of real estate and technology from an insider's perspective, with Rob Hahn and Greg Robertson. Hey, everybody. I'm so happy to announce our newest sponsor, RentSpree. RentSpree is LA-based and is a provider of award-winning rental software that helps real estate agents, owners, and renters to simplify and automate the entire real estate rental process. From listing to lease, these guys have got it figured out. With nationwide coverage, RentSpree is an all-in-one platform is known for its easy and secure interface and suite of rental tools, including tenant screening, rent payments, marketing, and renter management. To date, RentSpree has partnered with over 250 of the most influential MLSs, associations, and brokerages, and they have over 1 million users throughout the U.S. That's great. In fact, they just announced a deal with the Miami Association of Realtors. This brings their agent count in Florida to over 120,000 agents, with over 600,000 total in the U.S. that is able to access RentSpree through their MLS or association. RentSpree is ranked 625th on the latest Inc. 5000 fastest growing companies list in 2022. Also, check out the show notes for rentspree.com. They just issued a white paper that talks about the opportunities that agents can have by incorporating rentals in their business model. I've written a lot about this. I think it's a great strategy. So please visit rentspree.com to download that white paper. Thank you, Michael, and the entire RentSpree team for sponsoring Industry Relations. Rob and I really do appreciate it. So go visit rentspree.com today.
Hello, everybody, and welcome to another episode of Industry Relations with Rob and Greg. My name is, of course, the notorious ROB, the Rob Hahn. And with me, as always, is the fabulous Greg Robertson.
Hola, Rob.
Hola. Good morning. How you doing?
All right, man. You know, it's another day in the life here.
Yeah, as we're recording, I think we normally record like Fridays, kind of reasonable. We're recording early on a Saturday, so you gotta get the energy up, man.
Yeah, I woke up early. There's a car show that happens about a couple blocks from my house, so a lot of Saturday
Cars and
mornings
coffee?
I go to that.
Is that the thing?
It's kind of like that. It's called Donuts and Derelicts.
Okay.
So I was over there this morning with my my bus, and I'm talking to a lot of people, and then I'm like, oh shit, I gotta get back here and record this damn thing.
Yeah, right on. Wait, so is that kind of, you said donuts and derelicts, so it's more like classic cars, or is it still like the exotics and the...
Oh, it's everything. Yeah, everything. Okay. So you get the classic cars, you get the, air-cooled stuff like I've got, and you get, all the hot rods and, everything. Yeah, okay. It's all over the place.
Yeah, because you can't really, I don't think you could go to donuts and derelicts with like a Veyron. You know what I mean? I just don't...
Well, I mean, there's been some Lambos. There's been some, they bring all sorts of things out there. Some of the local dealers bring some of the McLaren. I've seen a couple of those. So, yeah, I mean, it's all over the place, right? Yeah. It's just people that are into cars, right?
I'm just saying it's off-brand, Yeah. Bugattis and Lambos, it's not really a derelict. I mean, we could call it a derelict.
Yeah, I mean, I think it started just hot rods. And then it's kind of evolved over time. It's been going on here in Huntington Beach for a long, long time, right? So
that's very cool. Yeah, one of these days, I think it'd be cool to go see one of those. But dude, we got some stuff to talk about. So, as we all know, it's earnings season. Which is one of my favorite times of the year because we get to hear from all these real estate companies and their CEOs have to come tell us what's going on. And there's been a couple of bombshells. I think. But there have been a couple of sort of expecteds, right? I think Remax reported, as Realogy reported, and it's kind of what we expected. The market's terrible. Both of them kind of squeaked by, kind of managed to make a little bit of money, but it's bad. And we've known that. But Zillow and Opendoor have been the two that were like, damn, what? So which one should we start with?
Well, which introduced what did their earnings first? Was it Zillow or Opendoor?
Zillow went first. Yeah.
Okay, well, let's talk about Zillow.
Let's talk about Zillow. So, what's interesting about Zillow is they had a pretty decent quarter, all things considered. They made money, it just wasn't as much let's see here. EBITDA. I mean, or no, I'm sorry. They actually
they
lost
didn't make money that I know. Yeah.
They when I was looking at the EBITDA numbers, but net they lost money, but it wasn't as bad. That's what's interesting. Look at least on a quarterly basis, or even on 9 months. Last year, first 9 months, Zillow lost 267 million. This year, only lost 29 million. Right?
Yeah, that's a success, right?
It is a success.
Part of that.
And that's the funny thing to me. It's like real estate guys like it didn't make money. I'm like, well, their EBITDA was 441 million, so the losses, a lot of it come from stuff like stock option grants and shit like that, non-cash. They're cash flow positive. They have something like $3.5 billion in cash. I mean, they did okay, right?
Yeah, I think what's helped them is that I think it was last quarter or maybe it's just a few months ago they got rid of the inventory.
Right, and a lot of the loss was
out of
that.
iBuying. Yeah,
correct.
So that was fortuitous in that sense. I mean, it's still kind of an ugly quarter all around, but yeah.
Hold on. But so considering all of that, they did pretty well, right? But obviously they talked about, like every CEO talked about the market's rough, the macro conditions. That was a big part of the Q&A with the Wall Street guys. And Zillow's expecting it to be bad, right? Volumes to be low, prices will be bad. It's probably going to impact their premier agent business. So they talked about a couple new things, but it's in line with the super app thing that Rich Barton mentioned. That's the thing 1Q.
I mean that's a little bit that's an interesting strategy because they do keep referencing the super app. So I mean, that's a lot of pressure on whoever's building the super app, right? I mean, I hope the super app
bet it's all of
super.
Them. Yeah.
But
we got a little bit of insight into what the super app is, and the biggest pivot, the biggest sort of news that I heard from that was they're really focusing on like touring, obviously, but we knew that, right? Showing time, they're like touring is the big thing, so they're really going to emphasize touring, real-time touring. That's real positive overall. The one that's kind of got me scratching my head is they're going hard into mortgages. Like hard, right? So obviously we know that, they always had Zillow, not always, but, a few years ago they bought Zillow Home Loans. I've written about it. I was like, okay, but it wasn't just a mortgage broker, right? Because typically most brokers, when they have ancillary, it's mortgage brokers, right? Zillow went and bought a mortgage lender, that could do its own underwriting. And I always thought this was about iBuying, right? This is about, okay, Zillow went and bought a home. They want to sell it. The buyer comes in. They want to be able to say, here's a loan, right? If you need a loan, we could do that for you. So you could buy our house. I always thought that's what it was. I think the industry thought that that's kind of what it was. And that's, in fact, what it was. They weren't really about your traditional refi, purchase mortgage. This earnings call, what I heard very clearly was they're like, no, we're going to purchase mortgage. Right? Refi business is dead. Everyone knows that. But because Zillow has such a massive advantage in traffic, they're like, we are going to go, lean heavy into it. I guess before this, they were really when somebody says, hey, I need a loan, they would just send that off to a mortgage lender. It was like a mortgage marketplace, right? Now it's like, no, it's coming to Zillow Home Loans. Right. And they're going to do more to sort of really push that because mortgage is a critical part of the overall buyer journey. So, I don't know. What's your thought on that? By the way, your mic is a little soft, Greg.
Sorry, I'll get closer here. So to me, this is right in line. I mean, a lot of people that talk about quality of products is that you got to own the whole stack, right? I mean, you got to like, if you want to really make a great experience, you've got to own the whole stack. I mean, so shipping things off to somebody that's its own thing. But I was at this that T3 Tech Summit, and one of the speakers there was Jimmy Mackin, and he did a wonderful job of talking about the differences between what kind of Zillow provides agents and what a normal broker does, right? And this goes to me with the same thing of this thing of like, it's one thing to kind of shoo off like, okay, here's our mortgage guys, and then another thing to be, it's part of the process, right? And what Zillow does that no brokerages really do is that they don't provide leads, they provide appointments. right? And the difference between a lead and appointment is, the Grand Canyon, really, right? Especially, he even went as far as saying, if brokers, if you're providing your agents leads, you might as well just light all that money on fire, right? You need to go the step further to kind of get them all the way there, because they're not going to follow up, and they're, another thing is they're not going to follow up, right? So I think Zillow is kind of taking that kind of stuff, and they got to like now with this mortgage and anything else is like, how do I get all that part of the experience, right? This goes back to what we talked about with showing time. It's like they want somebody to be in front of a house, click a button, and then an agent show up, right? I mean, so all these things are about an experience they want to give a consumer that, that they haven't really experienced before, right? So I think now whether that's going to, what happens there is going to be, interesting to see. I mean, how many people are going on to Zillow that are unrepresented, right? I mean, I wish I knew that number, right? Because, that's the one they're talking about. Because typically if they're working with an agent, the agent's already got their kind of mortgage person signed up, and they've already got them pre-qualified, right? So
yeah, Rich Martin actually talked about that a little bit. I want to, and I'm sorry, the transcript hasn't been released. I listened to the earnings call. I want to say he said something like 40% of all of their buyers did not have a mortgage or something like that. It was a pretty substantial percentage. Well,
there's not have a mortgage and not pre-qualified too, right? Because a lot of times the agents will make them pre-qualify, and that gets them in their process, right?
So clearly this implies that they don't have an agent either, right? Because if they have an agent, then Zillow really doesn't have a premier agent lead to sell. So we're talking about, unrepresented buyers, like first starting out the journey, right? Just saying, hey, you know what, babe, we should think about buying a house. Let's go on Zillow. Let's start kind of looking around, right? And they're like, oh, what about this one? At that point, they're unrepresented, right? And apparently a big chunk of them don't have a mortgage. It was either like 40% or 80%. It was a big number.
Yeah, and again, if I remember correctly, on these attachment rates, they don't even really have to hit really large percentage of attachment rates to really move the needle for revenue and other things for Zillow. Yeah.
Yeah, I think they said they were trying this as Raleigh, North Carolina was kind of their test market for this new way of doing things. And I think in the earnings call they mentioned a 15% attach rate, which is pretty healthy. I think so. Yeah. Yeah.
But why? I mean, you said at the beginning, it's like, I thought they bought this company years and years ago. So is it the fact that the market's turned that this is giving them more, they're getting more success? Does that make any sense?
No, I don't.
Why are they having, they've had this company for a long time now, and they've talked, everybody talks about attachment rates and title and mortgage and everything else, but if you're saying that they were really highlighting that in the earnings call now, why is it, if they're seeing more success than they have been and they're highlighting that, why now?
I think the why now, so when they bought Zillow Home Loans, it was after they launched Zillow Offers, right?
So before you're saying it was a mortgage marketplace, and then it was the home loans was after the iBuyer thing.
Yeah.
The version 1 of iBuyer or version 2?
Version like 1.5 version. In other words, so if you think about the iBuyer journey, under Spencer, they started with iBuying Marketplace. Right. Like Opendoor, all these investors are going to give you offers along with a CMA from a premier agent. Right. That was the first version. Then they moved to, we're going to directly be a participant. Right. So that was we'll call it 1.5, 2.0, whatever you want to call it, when Zillow really became an iBuyer.
Yeah, that's 2.0 to me, but go ahead.
At that point, they went out and acquired Zillow. The Zillow Home Loans was bought at that point. And this was still under Spencer, right? And the idea was, I think at the time that, okay, we're buying these homes. We're going to try and sell them. These buyers need to get a mortgage in order to buy our house. Right, we might as well, sort of finance it as well, right?
Yeah, I don't remember. I don't think that 2.0 was under Spencer. I thought that's Rich came in and said, okay, we're fully committing to this.
I'm pretty sure they bought MLOA, Mortgage Lenders of America, under Spencer.
Okay.
Right? I'm pretty sure.
I guess that doesn't have to coincide with like them going full iBuyer.
Yeah.
right?
Yeah, clearly. And then when Rich came back, it was like, full throttle ahead, right? And Zillow Home Loans was never really like that profitable, right? It wasn't, and they were spending a lot of time and a lot of money building up the technology, the infrastructure, making it much more efficient for a couple of years. My personal thought, and I've written on this many, many times, I've talked about it many, many times. My personal thought always was iBuying was never about homes, it was about mortgages. So it made sense for Zillow to own a lender, like not just a mortgage broker, but a lender, right? And I thought that's like, it made sense. It was an overall strategic thing. The whole experience was centered around this market maker, that could provide. And then obviously when Zillow said, you know what, we're done with iBuying, we're out. That was a year ago. It was precisely a year ago. I feel like everything just kind of went topsy-turvy and I couldn't make sense of it. I was like, okay, now what, right? Like, what does Zillow Home Loans do now? Kind of thing. So to me, this is a year later, the answer. What Zillow Home Loans does now is effectively it tries to become Rocket Mortgage. I mean, I don't know how else to put it, right?
Right.
Effectively. It's just that they have almost all the buyer traffic in North America. Like Rocket still has to go out and, advertise and whatever, all these, whatever, Chase, Wells Fargo, all of them have to advertise. Every time you walk into a bank branch, it's, mortgage, right? Whereas Zillow's like, we have all the buyers, so we might as well serve them up with, do you need a mortgage? Like right there, and apparently they're having a good amount of success with it, right? So I think that's the answer this quarter. Right. And it's sort of shaping up like, okay, if you don't have iBuying as a central part of this process, then you have to have something. And I think that's the super app, right? That's going to help buyers and sellers both, throughout that entire sort of Zillow ecosystem and provide them with stuff and service that they need, right? All along the journey, and Zillow has all of the pieces, right? They have agents through Premier Agent, they have mortgage through home loans, they have title escrow through Zillow Closing Services, they have technology, they have, it's that. I feel like that's in effect the super app, right?
Right. So, but I mean, again, clearer. It goes back to my question. So I just looked it up. So they bought that company in November of 2018, right?
Yeah.
So, that's 4 years ago.
Yeah.
So again, why now is it doing better?
I mean, let's look at mortgage segment. Not really. I mean, mortgage segment lost a lot of money.
I mean, but you're saying they highlighted it like it was one of the things to talk about this quarter, right?
It was one of the 5 pillars of growth for future.
Okay.
Right? Because that's very ambitious.
So is this more of the same? I mean, I feel like everybody's been saying every company like, oh, we bought a mortgage company. I mean, Moto Mortgage over at Remax. Everybody's saying, or was there anything, was it just part of that narrative that they're always saying, or is there really something there?
Yeah, I mean, the something there to me is the fact that they said prior to this quarter, prior to this announcement, you could always ask for a mortgage on Zillow, right? But Zillow would be like sending those out as leads.
Well, hold on. I mean, but they bought this back in 2018.
I know, even with that, because when they bought it, the purpose was this is about iBuying. Right.
Okay.
So they never did this, right? They always had this like third-party relationships. What they announced this quarter was those are all gone now.
Right.
It's all going to Zillow Home Loans, basically. Right. And the other sort of interesting, relevant part is, again, looking at just the rally test market that they did this in. I don't want to say it's required because that would be, that would be problematic. But I feel like it's a strongly encouraged part of the relationship with the Premier agents that they will mention Zillow Home Loans, right?
Right.
Which, I mean, it just makes sense. Like, I don't know how you get 15% adoption rate, right? If you don't have that, right? And Rich Barton specifically talked about how they have advantages in customer acquisition, which is, look, again, we're Zillow.com. We have all the buyer traffic. And the second piece was distribution, meaning they have, tens of thousands, hundreds of thousands of agents, right? So they could do distribution through that network, right? And as we saw, especially in recent times, whether it's Better or Tomo or even Rocket, right? The key to sort of that mortgage business is you have to get the local agent on the ground kind of to be on your side. This is something the mortgage industry is known for, 30 years, right? Like, we know all about the mortgage officer relationships and how they have to go, build these relationships with agents, et cetera, et cetera. So I think that's the next challenge to be had, right? Apparently they were pretty successful in Raleigh.
Yeah, I mean, it's not, and the problem is that the agents using Premier Agent have already seceded their fucking control, right? Because, again, like I said before, they're signing up to get an appointment, right? So Zillow's handling all the lead, the lead incubation and everything else. Mm-hmm. I mean, and then it would be kind of crazy for the agent that says, okay, well, I want to use my own mortgage guy. Well, you've already surrendered all this other stuff here, right? So if you want to kind of, still be on this program, you have to like surrender. It's just, again, it's like it's the Uberification of the whole thing. I mean, really.
So you think it's just, so that just raised the question, like, is there any sort of, I guess the way to think about it is, how do you think the industry thinks about this?
Well, I mean, again, going back to that talk what Jimmy was talking about, it's like, most mortgages, most brokerage have some sort of like, this better than I do. Like, it might be a cut of like 25%, right? With caps, right? Zillow's like 45%, right? And like, he did this like little experiment where we went on Twitter, like, your broker says that because of the economy, they're raising splits to 45%. What do you do?
Right.
I leave. I start my own. Everybody's pissed off. Yeah. Meanwhile, Zillow's getting that every freaking day.
Yeah.
So what's the difference here? What is Zillow doing that you're not as a broker that is allowing them to kind of charge such high split rates, right? So, it's how the industry is taking it. More people, there's a lot of people that sign up to become a Premier Agent. And then the other part about that is like, if you don't do exactly what Zillow wants you to, they kick you off. They got somebody waiting in the wings anyway. Right. So it's really just, it's as you said, it's like, because they've captured all the buyers in the U.S., it just gives them so much power and control. Right. And it's just, instead of just selling ads, they're just like, how else can we do this? Right. What other things can we do to maximize that traffic for sure?
Yeah. Yeah. All right. Yeah. I mean, that was, like I said, it was the bombshell. What's interesting about it is the timing. Right. It's like, sure, it makes sense strategically, and I'm sure they've been thinking about this for months. I don't think Rich and Zillow and any of those guys knew that the mortgage market was going to absolutely tank. Like, talk about a bloodbath. Who was I speaking to? I was talking to one of the guys at T360 and just talk about, look, macro wise, like, mortgage already felt it, because they've seen refi volumes are down like 90%. Purchase volumes are 40-year lows or whatever. So like, mortgage already laid off thousands and thousands of people. It's a bloodbath in that industry. The thinking is that's going to come to real estate next year, right? We're already starting to see sales volume be, dramatically down. Prices aren't down yet because a lot of reasons. The thinking is that. Right. I
think to me, though, it's like it almost had to happen. I mean, this nonsense of like 50 bids, and the price is just going through the roof. I mean, yeah, it's impacting the mortgage industry with these rates going up. I mean, and the Fed, gave a little bit of sign of like they might pivot in the future, but I mean, another 75 basis points, they were full steam ahead, right? Maybe next time. I think the way that I heard it is like, maybe it's 50 next time, 50 basis points or something, but still,
yeah.
I think they think they can do, as long as jobs are up and there's still a lot of equity in homes. I feel they're going to keep going until one of those two things kind of changes. But it's ugly out there for sure. I know many people are affected by, I think Zillow, what was the last week of October, 300 people laid off. Mm-hmm. And there's been others, in other companies as well.
Yeah.
It's so when you say real estate is going to feel it next, real estate's feeling it now too, right?
True. True. I mean, Compass laid off, Redfin laid off. Everyone's laying off.
Everybody's laying off, right? I mean, I know, October is traditionally the time when companies start doing budgets for next year and their annual operation plans and everything like that. So, I know from, everybody's thinking about this. What does next year look like, right? So it's going to be interesting for sure.
What's interesting is, of course, there's a lot of money sitting on the sidelines, waiting to swoop back in, at some point. They're going to be real opportunistic in the spring, maybe into the summer, whether it's homes or companies or whatever. So that'll be interesting.
Yeah, I don't, to me, it's like, I think 23, sorry. I mean, that's going to be a pivotal, that's a hunker down year. I don't think we're going to see any, maybe a normalization of the market because those rates are going up where you get more, the supply is, becomes a bit more, so you can kind of even things out. It's still a seller's market, right? With the supply levels, but hopefully maybe there'll be some normalizations, but I think it's going to be tough. Yeah, it's going to be tough for a lot of people. Yeah.
All right. So I'm sure we could spend a little bit more time. I mean, I certainly need to write something up on Zillow and just look into it a little bit more. This is just sort of a first reaction kind of thing. The numbers look fine. Numbers looked okay. Their losses were not as bad. But then again, that's compared to last year, right? Zillow has cleared out all of the inventory, so they're no longer in the home owning business, right? That's done. And they got out. I'm sure they took a little bit of losses, right? Just because the market has done what it's done this year.
Their stock is,
right?
More than a little bit, right?
Their stock's been hammered, but now that they've cleared this out, it's possible we could see them kind of back, right? Because the IMT business is still really, really healthy,
Still down, though. I mean, it's not growing. It's not growing.
It's not growing, and they talked about that, right? They addressed it because, again, as the market declines, you're going to have fewer agents be able to spend, on advertising, spend on stuff. But same thing. Last downturn, a lot of the great big agent teams of today were built in the last downturn, right? Where everybody else was like, oh my God, and fleeing. These guys doubled down. They invested, and, through whether they were doing REO business or just getting super aggressive. Like, we know that when COVID happened, I know for a fact there were agent teams who doubled market share, right? During the first, early part, right? When everyone was freaking out. Oh my God, I don't know how to, it's like, I have Zoom, I have drones, like, let's go get it, and they did. So I think Zillow's going to be all right, especially on the premier agent side. It's just whether they're going to be able to hit those 5 pillars thing is going to be real interesting,
Yeah, I think they'll be all right. But going back to the levels they were at before, I mean, and sometimes that the stock price isn't reflective of that. I mean, that's going to be ways for all real estate to kind of gain back into those gains.
But the other really interesting company, right, was, of course, Opendoor, right? And, the Twitter, whatever, the real estate social media is all just like, they lost $1 billion this quarter, That's the talk.
And again, huge layoffs as well.
550, 18%, like big layoffs. So it's like, okay, yeah, that's bad.
Yeah, I mean, I don't know. I mean, I think both of us are long on Opendoor, but this is a soul shaking, type of event. This last earnings call is like, $1 billion. Good Lord.
Yeah, but so I dug a little bit. I went through the transcript. I looked into numbers a little bit, and it's actually not that bad.
Okay, please, pontificate on this. Please explain.
Yeah, I mean, most of the losses.
It wasn't $2 billion, right? So how bad could it be?
No, like literally, it's like what I'm saying is it's bad. Right? It's bad. No, it's not like Eric came out and took a victory lap. That's not what happened. Right? It's bad, and he acknowledged it's bad. Thing is, as I'm looking through it, these guys are making all the right decisions. You know what I'm saying?
Okay.
No, here's if you look at most of their losses, like 550 million of it or whatever, it's because they did 2 things, right? Number one, they entered into a bunch of contracts earlier in 2020, earlier this year, right, at the higher prices. And they chose not to cancel them. In other words, they went to they knew, oh my God, if we go through with this purchase, we're going to lose our ass. Right. And they said, but we're going to do it anyway because, brand, you know what I mean? They really felt like
reputational stuff. Yeah.
If they just started withdrawing their offers, then their whole company, the whole brand is built on the idea of, as a seller, you have the certainty, right? That you're not dealing with a retail buyer who might not qualify for the loan. You know what I mean? Things could fall apart. No, this is a big institution coming in and offering me a check. I'm paying them 5%, fee, plus I'm taking less money, right, on the barrel. But in exchange, I get the certainty. Right. And so they said, you know what? We're going to lose our ass. We're going to go through with it. So they bought a whole bunch of homes they knew were overpriced. Right. And they saw the trends and said, we're going to lose a lot of money on this stuff. Holy shit. And they knew it. And they did it anyway. Right. So most of the loss really comes from that. Right. They bought high and sold low. Okay. Well, as a market maker, especially if you decide to go through with it on purpose, that's to be expected. Right. But since then, so again, looking through it, they went completely risk off, meaning they're like, okay, we're going to get super conservative. As a result, they've been offering way less than what they were. So they redid their model, right? And they did talk about it. Look, the speed of decline is the
velocity is what everybody talks about, is how crazy it was, right?
Yeah, it's just we've never seen this before, right? So they remodeled it, and now, so from sometime in July, they've been offering way less. And in their financial lease term, the spreads are way higher than there's ever been. Right. And they did talk about those homes are doing well. Even in this market, those homes are doing fine because they paid low and, then they're able to resell those.
Basically spinning this, and it could be true of, this is a one-time hit, one-time adjustment, right? Yeah.
It'll be a two-time. So they warned about Q4. They said Q4 is going to be the trough. Right. In other words, they're sort of look, if you thought it was bad, we lost $1 billion in Q3, they're going to lose $1.5 billion in Q4. You know what I mean? Q4 is going to be be the worst.
Well, what about the cash? I mean,
that's the key thing. It's all on paper.
I mean, if you lose $1 billion a quarter, I don't know how many people have, billions of dollars in cash to kind of make what do they got? 3 quarters left? I mean,
no, they have about 1.5 left, right? And
so that's gone next quarter.
If they lose that much money in cash, but cash flow and losses are a little different, right?
Right.
So they're going to book the losses. A lot of it is inventory write down, right? And the homes they've bought since are doing well. So they'll be able to sell those homes at a profit, right? Even into this market, because they're anticipating the pricing curve like this. So presumably they bid under that, right? Knowing that, if in other words, if you're look, all homes are going to drop 5%, over the next 3 months. So they're going to go and offer 10% less, right?
Right.
So in other words,
and I think they also talked about, I believe, and this goes back to velocity, is just the turnaround time of refurbishing homes. They're trying to kind of get from
correct. They're
25 days to 15 days or something like that. Right?
Correct. So they're doing all the right things. So I'm looking at I don't care who you are. I don't care if you're Elon Musk. I don't care if you're Jeff Bezos. I don't care. You're the greatest businessman that's ever lived. Warren Buffett. I don't care who you are. You're caught in this situation. Right? You own all these homes, all these assets whose value is just plummeted. They're just getting rid of it, man. Right? They're doing the right thing. They're not trying to hold on saying, well, the market's going to improve. No. They're just fire sale, right? Take the loss. Just get rid of it. And they did talk about, to do this, you have to have capital. You can't, you can't take those types of losses unless you have enough capital. And they're we have plenty of capital. At one point in the call, I think it was Eric, it might have been Carrie, the CFO. It's we actually feel we're pretty well capitalized. They have over 1.5 billion in cash. They have 11 billion in just access to capital through lending facilities. They got another 700 million. The borrowing costs are going to be higher because rates are higher, but they have it. They have the money. And as long as they know what their borrowing costs are, they can make adjustments, and they're making those adjustments, right? So that's all I'm saying. They're making all the right moves, right? So this isn't we took $1 billion loss because we're idiots. We took $1 billion loss because the market did what the market did. We'll see, right? There are two other things that came out of this that was interesting for me. One is that they think after next quarter, when they have cleared through sort of this old inventory, right? And in order to clear through it, they're going to be really aggressive on pricing. So if you're a home buyer, now might be a good time to go make a bid on an Opendoor home, right? Because they're going to price it to just fire sale, right? That's
right.
one.
Now, these are the new homes that they're buying? I mean,
no,
new homes.
So they're trying to get rid of the old inventory that they bought too high. The new homes that they're buying, of course, they're trying to sell those too, but those they bought low enough that they're going to make money, right? On that front, what was really interesting that came out of it was they talked about their conversion rate. So historically, apparently, Opendoor's conversion rate was over 30%, meaning 3 out of 10 people they sent an offer to took it, right? What's surprising and very encouraging, if you're an Opendoor bull like I am, I'm long Opendoor, right? Is they're at 10 to 15% in this market when they were making
30 before offers. And 10 to 15 now.
Yeah.
So 30% of people would take offers
before,
and
historically.
Now 15.
Correct.
So less people are taking the offers.
Correct. But it's way more than they expected because what they were doing was they're making lowball offers, essentially, right?
Yeah, you have to explain that. I mean,
right. So prior,
it's like they lost $1 billion, and I think they're doing everything right. Less people are taking their offers, and I think that's brilliant. I mean, it's a very counterintuitive.
It is counterintuitive. I know. So I had to read through it. I was like, wait, what? But here's the point that they're making, right?
They're almost out of business, and I think that's
dude, they are far from out of business. Opendoor's actually doing pretty well, I think. But here's what I'm getting at. Like, what they're doing now, again, you have to read through all this Wall Street financial leads. What they're doing now essentially is offering way less than they've ever offered, right? So let's say you think your home is worth $500, right? Before, they would come in and offer maybe like $495, or if not 500, like we'll just give you a list, right? Because you're going to pay us 5%. Now what they're doing is you think your home's worth 500, we're going to offer 450. We're going to offer 400 because we expect home prices to decline by the time we are finished.
Right.
And they're saying even with that, they're getting 15% of people. Yeah, sure, I'll take that offer. Right. That's a big number, man. That's really encouraging to think that. And so he got asked about it, right? One of the asked like, can you explain that? Like what's going on there? And his explanation essentially was interesting, twofold. Number one, they have a lot of institutional clients, right? And we knew that Opendoor did have big institutions. Now we've learned, this is the first time I heard them mention a number, between 10 and 20% of their business comes from institutions.
I would have
large REITs.
Yeah.
What?
Yeah.
Things of that nature. And those guys are just like, sure, we don't give a shit. The other one, though, is he talked about there are a substantial number of sellers who have a lot of equity, especially over the last 8 years, right? And those people value their time and whatever more, and they're willing to just take these low ball offers because, like,
for convenience,
I'm still coming out ahead, right?
Yeah,
that's a big number, man. That's what I'm getting at. So 15%, let's say, being the limit, that's a pretty healthy number, right? And this is, now, keep in mind, this is with real estate agents telling everybody you're an idiot if you sell to Opendoor. You're leaving all this money on the table.
Yeah, some do. Some see the advantages also because there's still some referral money that they can get there too.
So what I'm saying is like, yeah, obviously not as good as 30%, but 15% is way higher than I expected. That's a pretty substantial. That's a pretty healthy number. Right.
So they're dialing it in, right? They're dialing it in now to see what what that is, right? So it's better to get 15% of an offer they're going to make money on than 30% of people of offers are not going to make money.
Right. Correct.
The way you're putting it.
And the 30% that they were getting previously, they would have been fine until the macro environment did this. Right?
Yeah, it was just so quickly.
Yeah, and no one could expect this because last quarter they talked about, look, in any historically, like through the entire time we've been tracking housing, home prices never fell more than like 1%, in a quarter. Well, it fell more than that this time because the Fed went and said, we're going to jack the rates and, inflation is what it is and all of that. So,
well, I mean, I think, wasn't he the guy that, or one of those guys made the quote of it's a 40-year.
Yeah.
What was the context behind that? Because I mean, if we look back at the Great Recession here,
yeah.
I mean, to me that would be the that's within this 40-year thing. Do you know what they were talking about in the context?
They were talking about the rate, the speed,
the velocity
of rate increases is the fastest in 40 years. Right?
Okay. So what this, I guess, let's say, I mean, everybody points back to the 70s, right? When they had to do something. So I guess back then, yeah, I think maybe it was a lot slower, and that's the lessons we're trying to learn from on this one.
Yeah.
They just 75, 75, 75, right? So yeah.
So basically, the last time was when Volcker,
right.
And Reagan came in, so we have to crush inflation, and they basically put the country into recession, right? And it was 15% rates and blah blah blah, and it's the fastest, right? I mean, let's put it this way: if the Fed had done this by 25 basis points, right, kind of raise rates, and everyone say, hey, we're raising rates, but we're going to do it slower, then we're not going to see this type of turmoil. But I think the Fed wanted to send a message to everybody. We're really serious. We're going to just kill rates. We're going to kill jobs. We're going to put it, 75, 75, 75. I was listening to a different podcast recently talking about that. And, they think some people in the market, like I've been talking about, I think that they have to pivot. Like maybe I'm completely wrong because of Jay Powell and the Fed's like, no, we're going to keep doing this. And ultimately it's sort of like, where do you end up, right? And these guys were saying that they think the Fed's going to end up around 5 to 6% Fed funds rate, right?
Yeah,
which probably means more like 10% mortgage rates, like something along those lines. I mean, it's going to be brutal, right?
Yeah.
So that's
next year, man, it's going to be
interesting thing. Yeah, but that's my point. By next year, so Q3, Q1, Q3. Opendoor might be out of the woods.
Q3 of next year.
Q1 of next year. Right now, there's Q4 like right now, because they're in the midst of it right now. It's going to be the trough. And they mentioned it, right? It's because they still have a lot of these properties they bought back in Q1 and Q2, right? They have to get rid of it. They're going to get rid of it, right? They're not going to just hold on to it. They're going to get rid of it, and they're going to take huge losses on those.
Yeah,
right?
I disagree with that. I think there's going to be more turmoil next year. I mean, I think we're going to be. I don't think we're through the woods at all in Q4 of this year or Q1 or Q. I mean, I think all of 2023 is going to be ugly.
Oh no, of course. But all I'm saying is,
but I just don't, and I think that ugliness is going to translate into Zillow, Opendoor, and everybody out there, having to deal with it, right? So I don't think nobody's out of the woods. I don't think, I don't think there's, what you're saying to me, it sounds like is that once Q4 is over with, we're going to see less billion-dollar losses from Opendoor next year.
Right.
I'm not sure if I have that confidence.
I think it has. Well, again, now the whole question is execution. Like, is the team there good enough and smart enough to, in other words, the question is, are they able to buy houses low enough, right? Because you're right. If we think that everything's going to be still really bad in 2023, but as an iBuyer, if you then say, okay, if I think home price will be 30% lower, I'm going to bid 30% less, then they'll be fine, right? So it's all about, like, what do you expect, and does your expectation come through?
Yeah, I think, the thing that could help here is that, some of the stuff I read is like the sellers are still greedy. Their neighbor across the street sold for $400,000 more than what my agent told me to list. And they're like, my house is better than that. It's like, maybe next year these sellers will just, they're realizing it now, but maybe they're going to wake up a bit more and know, like, this isn't Kansas anymore. Right.
And I think that's the case across the board, right? And I think we're seeing it in houses. I certainly have been following a little bit on what's going on with, like, the used car market. like a lot of these car dealers and, you know, people are not coming to terms with like where that market is now. We're seeing an M&A, right? You know, like we talked about CoStar the other day, you know, and he's like, we're looking to buy companies, but sellers are not realistic, you know, like they're not adjusting. It's happening in venture capital, right? A lot of VCs are like, look, we still have money to invest. We have to deploy funds if we're going to make money, but the valuation we're seeing is not reflective of market conditions, right? It's sort of that kind of thing. I'm like, all right, you know, it is what it is. My point simply is that if Opendoor can execute, and I see no reason why they can't, they have a long track record of executing, then the moves they're making now should mean that by Q1, they're mostly out of the woods, right? That's all I'm saying. Like, they're mostly out of the woods. I'm not saying they're out of the woods. None of us are out of the woods, but it gives me some reason for like, okay, these guys at least know what the fuck is happening, right? And they're making the adjustments. They're going, quote, risk off. So that's good. The second piece, though, is super interesting. They're really launching a third-party marketplace, right? So Opendoor exclusives, right, is something that they rolled out a few months ago. Yeah. I think in Austin, Phoenix, I want to say. Dallas, it was a couple markets.
Well, whatever markets, I mean, yeah.
So apparently, they're now really expanding that to third-party exclusive marketplace, right? Meaning,
explain that to me.
Yeah, Opendoor exclusives. Opendoor goes and buys a home. So Opendoor has a bunch of homes in inventory, right?
Yeah.
For 14 days, you can go on Opendoor.com and buy that house, right?
Yeah.
No haggle.
I'm familiar with how that works. Yeah.
What they're saying is now they're going to allow homeowners to go on Opendoor.com and put their house up as an exclusive. So Opendoor didn't buy it. Opendoor doesn't own it, right? Like I own it, and I go on Opendoor. I say, "Here's my house, and here's the no haggle buy now price." And you as the buyer can take advantage of all the Opendoor tools. Me as a seller can take advantage of all the Opendoor tools. That's what they're launching.
And is there a listing fee for this, or is there a?
It's probably the 5% fee that they charge sellers, right?
But that 5% fee would include like that's supposed to be refurbishing and blah blah blah.
Correct.
I mean, there's a lot of things there.
I'll go look through it again because I just sort of skimmed it a little bit. But that's
I mean, we talked about this before. We went back and forth on this, and I thought the whole reason they were doing, one of the big reasons, and maybe it was the main reason they did the deal with Zillow, was because that was their strategy, is to build this, to have unique inventory. And that's what everybody wanted, was a unique inventory, right? So that you would get to a point where like, I'm going to check Zillow, but I got to check the Opendoor site because those aren't on Zillow, right? So this to me is another sign of them wanting to accelerate that portal, right? So by allowing FSBOs, I guess, on that site, they're able to expand the inventory on there now.
Right.
I would have to kind of. That's very interesting to me. I didn't read that, so I have to read a little bit more into that and see how they're charging for that. Is there a
It's going to be 5%. I just looked at it.
It's 5%.
Right.
And so, let me ask this question: if they listed on Opendoor, do they have to then use Opendoor as the broker, if indeed as the agent?
That's a really good question because
that's where the 5% would come in.
Well, 5% is just a fee. It's just a service fee for using the.
But that's the same thing as they're kind of. You list with us. It's if I buy you, it's 5%. I mean that to me sounds like. So if somebody comes on there and says, "I want this house," Opendoor knows that. Okay. Opendoor then goes to the FSBO and says, "Okay, I'm buying that house because somebody wants to buy this, and that's 5%."
No. This would be simply the buyer just buys directly from the FSBO.
The buyer buys directly from the FSBO.
Right. And maybe Opendoor gets the mortgage. Maybe not. Opendoor's happy with getting the 5% because here's the thing about that 5%. Opendoor has no capital at risk.
But
they're just matching.
They also want. Yeah, but I mean, to me, you want a professional in that situation, right? You want the certainty of like, you don't want to, okay, hey, Mr. FSBO, who who doesn't have their shit together and Mr. Buyer who possibly doesn't have their shit together, let me know when you're done with the transaction so I can get my 5%. No, no, motherfucker. I want to be the guy. Okay, I got these two guys. Let me make this happen for you. Right? I want to control that. I mean, there's got to be some level of control they have in there. They're not just going to let these guys go off into the wilderness, make a deal, and then let me know when I can get my 5%.
Well, so the only other thing I saw was the big feature of the third-party platform. Number one, what they talk about is as sellers, you can use all of the Opendoor tools, right? So whatever tools and features are available in an Opendoor-owned house, you as a seller can use as well, right? The whole unlock the door with Opendoor app. If you want to install that smart lock, whatever, you can use all of that, right? The thing that they mentioned was a $50,000 appraisal guarantee, right? So I guess as a seller, if you go on Opendoor, you put it on that website, Opendoor will offer a $50,000 appraisal guarantee, meaning if it doesn't appraise, if it's right, they'll step in with here's money to make up the appraisal gap. Right?
Interesting.
Very
that's really I gotta read more on that. That's very interesting.
So when I started thinking about
there's some details.
So let me get this straight. If you have to go, this is a no haggle buy now price, right? There's no offers. It's $500,000. Here are the conditions, right? If turns out I failed to disclose something, so it doesn't appraise, Opendoor's going to step in and make whole, right? What negotiation? If I'm a buyer, there's no back and forth. It's like, oh, 500. Yes, I want that, or no, I don't want that, right? There's no negotiation. There's no back and forth. What do you need a professional for?
Right. You need a professional to get more than what you're offering there, right? That's what you need a professional for. You're giving that up.
Or if you do, then from an Opendoor standpoint, but we don't care. Go have a professional, right? It doesn't affect Opendoor in any way.
Well, if they have a professional, so they've got a listing agreement with a professional, then they can't, I don't think they can put it on that site.
Sure, why not? As long as you're paying 5% to Opendoor, what does Opendoor care?
Right. I mean, they would also have to put it on Zillow as well.
Presumably. Well, I don't know, because we don't know what the Zillow Opendoor partnership specifies, right?
But the MLS, if you've got a listing agreement with an agent,
right? But that's the
part
listing
of an MLS,
agent. Right?
They have to put it on.
Correct.
IDX,
That's the listing agent's problem, not Opendoor's problem, right?
Well, if they want to remain friendly with MLSs, it's part of their problem.
What? To explain, what do you mean by that?
Okay, you're saying that people that put sellers that put this on the private network of exclusive listings from Opendoor can use agents. Okay. Now, first of all, if they're using an agent,
I don't know. Wait, I don't know. We don't know the details of that. Let's assume they can.
I'm just saying, if you're saying that's the case, well, first of all, if you sign with an agent, you sign a listing agreement,
right?
Well, it's no longer exclusive because it's going to be on Zillow. So I don't know why they would be using that in the first place. So I just don't think that's the case.
Okay.
So, yeah.
So you think it's going to be FSBO, basically?
Yeah.
Either FSBO or you.
If it's not a FSBO, then it's represented by a broker. If it's on a broker, it's on IDX, which means it's not exclusive.
Yeah. That's a very good point. All right. So we have to assume this is essentially just a managed FSBO platform.
Right. I mean, again, I think if somebody makes an offer on that site, they're going to be going through Opendoor's process.
Right.
And Opendoor is going to be going to the seller, okay, we're buying your home.
Right.
And here's the 5%. Or there's some sort of legal kind of transaction where we're facilitating this, right, to make this connection. But Opendoor is going to control that transaction. They're not going to let these two people do it by themselves. No. Opendoor is going to control that transaction.
What do you mean by control the transaction? Because there's not a whole lot to control if you have a flat buy now, but this is it, no haggle.
Well, I mean, there's still, like you said, there's the appraisal, there's the title, there's the paperwork that has to be done. I mean, there's a transaction that's there, right? I mean,
sure,
it's not,
an Opendoor,
and some FSBO guy, a lot of times they just don't understand. Well, damn, I got the radon sheet I've got to sign. Whatever.
Yeah.
Maybe that goes away because it's a cash offer, but still, there's a lot there.
Or even if it's not, then Opendoor's got a bunch of forms and it's a managed FSBO. I mean, to your point, right? So it's
but they're going to be the one managing it because they want the certainty that transaction is going to close, right? They don't want these two randos to get together and let me know when you guys are done. And that doesn't make any sense.
I guess. What I wonder is, it's depending on how automated it is, they might not care that much, right? Because they're not spending.
Well, it's not. If it's not automated at all, if they're just telling them to go work it out themselves, and if it's the automation is coming from Opendoor, well, that's what I'm talking about.
Yeah, that's what I mean. What I mean is, if Opendoor staff is not sitting there having to shepherd this, right?
Opendoor staff has to shepherd this.
Why?
That's what I'm saying. Because again, they want this. They want the transaction to close. They don't want it. They don't want to be out. Again. You guys let me know when things are done. I mean, yeah. I don't see any. That doesn't make any sense to me.
Wait, so if it's just a platform, it's like, all right, a FSBO comes in, they list their house, they agree to pay Opendoor 5%, right? It says there are a bunch of articles, a bunch of forms, right, that you can download and do whatever. And for the buyer, it's like you come in, you see the house in Opendoor, you click buy now. Congratulations, you bought this house. Here's the seller's info. Here's escrow, title. Here's the title company, which would be Opendoor escrow, let's say.
I think it's a lot more complicated than you make it out to be. But I mean,
it probably is.
I mean, let's. I have to read to see what they're doing, but it'd be highly unlikely they just, with whatever platform or not, that there's not somebody shepherding that deal.
Read it. So, like I said, all of the headlines in real estate has been around $1 billion loss. Right. And was like, Opendoor's failing. They suck. Da, da, da. I'm like, as is typical, you're just scratching the surface and just seeing the big numbers and going, Rah! Look beneath the surface and they have cash. They're doing fine. Not fine. They're going to survive. They'll be all right. Right now it doesn't look like they're anywhere close to desperation, fire sale type stuff. This third party platform thing is super interesting. And it turns out this has been their plan all along. I didn't know this. Eric Wood talks about Series A deck, right? So Series A venture round, when they went out with it, they talked about creating this platform where Opendoor is one of many buyers coming into a seller and say, we'll buy your house. Right. So this is sort of the perfection of that vision, right? And I'm like, that's pretty interesting. Yeah, and it's a new...
Yeah, I mean, we've had that argument before. I mean, I thought that this exclusive thing was a way bigger deal.
I didn't think it was. I did not. I have to admit, I got this one. I misread this one. I thought Opendoor exclusive is fine, your own inventory. Allowing third parties to do it, I thought, Opendoor's a broker that belong to MLSs. There's an issue there. But on the other hand, when Sunny told me about this, she's like, well, if you don't sign a listing agreement, that's not a listing. You don't got to put it into an MLS.
They own the property. They can do whatever they want with it, right? So,
even if you don't own it, though, right? If you don't sign a listing agreement with a FSBO, it's not a listing.
Right.
Right? You're just signing a platform usage agreement, right? I'm like, okay, that's interesting, right?
I think that the thing that I would imagine how it works is once an offer is made, then you have to sign the listing agreement, right? So it's a little bit of a coverage that way.
Once an offer is made, then you have to... Oh, I see. Okay. So you're saying you can list it, but then when a buyer comes and clicks buy now, you're automatically listing with Opendoor.
Right.
And then an Opendoor agent will shepherd the whole process through. That's what you're... Okay.
Yeah.
Yeah. Okay.
Because then it'll basically show up on the MLS as a done deal, right?
So if Opendoor can do this, can others do it as well? Could Keller Williams do it?
Zillow. I mean, maybe, but Zillow. Other companies have to buy homes, right? I mean, I guess Zillow does it now. They have the other tab. They can, people can put, their listings on that other tab. It can't be on the tab that has all the MLS IDX listing. But
I guess what I'm wondering is, say it's Compass, right?
Right.
Can say, hey, we're not signing a listing agreement. Okay. Instead, we're going to sign a platform usage agreement, right? So you're going to put your home on compass.com, right? And minute a buyer clicks, like make an offer or whatever, the listing agreement between Compass and you get executed.
Right.
That way we can hold it off the MLS, right? Do it as an exclusive for however long it takes, and then we get a buyer, and then listing agreement gets executed.
Yeah, maybe. I mean, maybe. I think it's a little bit different in the luxury market, but I mean, I don't know. There's a certainty of like, Opendoor's, they're just built different from the ground up, right?
Yeah.
For a brokerage that's like, okay, we get properties, we list the properties, we sell the properties. That's what they know.
That's what they do.
This is a whole different. Yeah. This is a whole. You have to be kind of ground up from this, as he said. If the Series A deck, this is their vision from the beginning. Well, that's what it is, right? Because I think I'm not sure. Again, to me, the reason why they did the deal with Zillow was to accelerate this vision of exclusive listings. Mm-hmm. And but at least they have exclusive listings, right? And then this public, adding the public to it, only kind of supplements or expands that.
Yeah, the exclusive.
If a regular
listings.
brokerage, they're not going to have their own bought listings. It would be just purely FSBOs,
right?
With an asterisk, right?
Right.
And I don't know if that inventory is going to be that big enough where people are going to go there to look when it's only, 1,000 properties or whatever.
Because FSBO's historic is like 8%, so it's not a huge number. But 8% is really big if you're Opendoor, right?
Right. Right.
So it's a real interesting.
Again, this inventory differentiation is something everybody talks about, and you want to be at that point where, like, I'm checking Zillow and I got to go to the Opendoor because there might be something there too. That's where they want to be for sure.
Which read the earnings transcript.
I will
look into it more. Let's come back to this because like I said, we're early reactions. The implications of that probably are reverberating. There are things that we are not thinking about. Maybe some of our listeners will chime in with kind of their take, what the implications they see are. There's bound to be some. Like it's really interesting.
Yeah, so, I just have a feeling we've got some basic level of something wrong here, but hopefully not.
Maybe we'll reach out to Opendoor and be like, "Can you come explain this to us?"
Yeah,
we'll see if they'll.
That'd be great to have one of those guys on here. Eric would be great.
All right, that was an hour. Oh, God, like no wonder.
Take one thread and just pull it till that sweater's gone, man.
I was talking to someone recently. It was like, talking about kind of our total, like our audience market. I'm like, it's tiny because how many people give a shit about stuff like this? Like you and I do, and maybe 20,000 people, right?
But they give a shit enough that I always hear they're yelling at the radio or
not only that, but the 20,000 people are like the C-suite execs. So, we don't got a whole lot for like the average agent on the ground, but the people are telling those average agents on the ground, so and we managed to get an hour out of earnings calls.
I do want to, before we wrap, is just make a quick shout out. I know there was something probably at the beginning of the podcast, but thanks to Michael over at RentSpree for being our new sponsor.
Right on.
Totally appreciate that, and keeps us going. So big shout out to RentSpree. Everybody go to rentspree.com. I think any agent or broker adding rentals into the way their business model, it's a smart thing. I think they got a white paper on their site that talks about that, but check out RentSpree. I mean, just and our big thanks to those guys. We really, really appreciate it.
That's right. Well, big thanks to you for getting up early on you're already up. So
I was up, but here we go.
Yeah,
I'm not going to start the day.
We're going to see some photos and videos of this bus at some point. I'm just
yeah.
All right.
Follow my Instagram account. You'll see plenty. Thanks, everybody.
All right. Bye.